There is a market sitting underneath everything you see in the global economy. It doesn't trade cars, or houses, or even stocks. It trades bets. And that market is now worth over $600 trillion. That is more than 6 times the entire output of the global economy in a single year. It is larger than every stock market on Earth combined. Larger than every bond market combined. And almost nobody outside the financial elite understands it. This is the derivatives market. Warren Buffett looked at this beast in 2003 and called derivatives financial weapons of mass destruction. 5 years later, those weapons detonated. They were at the core of the fall of Lehman Brothers. They were the reason AIG had to be rescued at any cost. They were the hidden wiring behind the near failure of the entire banking system in 2008. And here is the most important detail. The system did not respond by dismantling the bomb. It responded by making it bigger. In 2008, the derivatives market was around $60 trillion. That was enough to trigger the worst financial crisis since the Great Depression. Today, that number is 10 times larger. More than $600 trillion in contracts, exposures, and leveraged positions stacked into a network so complex that no single regulator, bank, or central bank truly sees the full picture. When this system fails, again and, mathematically, structurally, there won't be enough money, political will, or central bank balance sheet in the world to absorb the damage. To most people, derivatives is just a scary finance word. Even many professionals can't explain it clearly. But derivatives now sit at the core of everything. Every major global bank, every pension fund promising you retirement income, every big insurance company, every government bond market from Washington to Tokyo, they were marketed as tools to reduce risk, to hedge, to smooth volatility, to make the system safer. In reality, they created a structure where risk doesn't disappear. It gets multiplied, layered, and hidden. Leverage on top of leverage on top of leverage. Bets upon bets upon bets. So tangled that when something breaks, nobody really knows who owes what to whom until it's too late. In 2008, when the derivatives market was just a fraction of today's size, the world had to throw $29 trillion in bailouts, guarantees, and emergency liquidity at the system to stop it from imploding. Not $29 billion. $29 trillion. Governments called it a once-in-a-century event, an anomaly, a black swan. But structurally, it wasn't a freak accident. It was the logical outcome of a system wired for maximum fragility. And instead of rewiring it, they simply turned the volume up. To understand why this is so dangerous, you need to understand what a derivative actually is. At its core, a derivative is a contract based on something else. Its value is derived, hence the name, from an underlying asset or event. That something else can be almost anything. A stock price, a bond yield, an interest rate, a currency exchange rate, the price of oil, wheat, copper, or gas, the probability a company or country defaults, even abstract things like the weather or a volatility index. You don't have to own the underlying thing. You're just betting on what happens to it. If that sounds like insurance on a house you don't own, you're beginning to see the problem. Because that's exactly what much of this market is. It's as if millions of people took out fire insurance on the same building. Most of them don't live there. Most of them don't own it. But if it burns down, they all expect to be paid. Now imagine the entire global financial system built around that kind of logic. Futures, options, swaps, forwards, each with a textbook definition that sounds reasonable. Each with a perfectly rational use case, like a farmer locking in the price of wheat, or an airline hedging against jet fuel spikes. Those stories are true, but they are not the main story. The real story is this. The derivatives market today is not dominated by farmers protecting harvests. It is dominated by global banks and hedge funds making enormous leveraged bets, often with borrowed money on interest rates, credit risk, and currency moves. On paper, they call it hedging. In practice, it becomes a system where a small movement in the wrong direction can wipe out the thin layer of collateral backing a massive notional bet, where a 1% move in interest rates can obliterate positions built on 100-to-1 leverage, where a single major default doesn't stay local, it ricochets through a web of contracts that spans continents. And that is how a housing bubble in U.S. suburbs morphed into a global financial crisis in 2008. That was with $60 trillion in derivatives. Now multiply that by 10. In the next part, we're going to go deeper. We'll break down how these contracts actually work, why a notional number like 600 trillion isn't just accounting noise, and how the same mechanism that quietly cracked in 2008 is now stretched to its mathematical breaking point. To see why this market is so dangerous, we need to slow down and strip away the jargon. On paper, a derivative sounds harmless. A future is just an agreement about a future price. An option is a right but not a requirement to buy or sell something later. A swap is an exchange of cash flows, like trading a fixed interest rate for a floating one. A forward is a custom, one-off deal to trade something at a set price in the future. All very civilized, very rational, very MBA textbook. In the real world, these contracts stopped being tools and became weapons the moment they were leveraged and mass-produced by global banks. The simple story they tell you, the official story, goes like this. A farmer wants to protect himself. He doesn't know what wheat will sell for in 6 months. So he sells a futures contract today, Locking in a price. If the market price crashes later, he's safe. If it rises, he misses out on some profit, but at least he survives. An airline fears oil prices, so it uses derivatives to lock in future fuel costs and avoid sudden spikes that could wipe out its margins. A multinational company earning revenue in euros but paying debts in dollars uses swaps to smooth out currency risk. These are real use cases. They are the poster children of derivatives. The examples, regulators and bankers show you when they want you calm, compliant, and uninformed. But these stories are like pointing at one small campfire while ignoring the burning forest behind it. What derivatives became on Wall Street because once banks realized they could bet on anything with borrowed money while collecting fees and pushing the risks off balance sheet. Derivatives morphed into something else entirely. Take a simple interest rate swap. On paper, it might be $100 million in notional value. Two banks agree. One will pay a fixed rate, the other will pay a floating rate. They exchange the difference, but they don't post $100 million in cash. They might only post $1 million in collateral. That's 100-to-1 leverage. A tiny movement in interest rates, just 1%, can be enough to vaporize the posted collateral. A 2% shift. Now someone owes money they simply do not have. Now multiply that kind of exposure across thousands of contracts, dozens of markets, multiple global banks, and you have something more like a geometric amplification of risk than a simple insurance contract. This is the first dark secret of derivatives. The notional value may be theoretical, but the stress it creates is very real. Insurance, on someone else's house. It gets worse when you look at credit derivatives, especially credit default swaps. In theory, a credit default swap CDs is just insurance. You own a corporate bond. You're afraid that company might default. You pay someone a premium to insure you. If the bond defaults, they pay you. But Wall Street did what it always does. It removed the requirement for ownership. You no longer had to own the bond to buy a CDS. You could simply bet on whether something would fail. That turned CDS into something grotesque. Dozens of funds could buy insurance on the same bond. A single mortgage bundle could have many times its value bet against it. Nobody had to own the underlying asset. They were just gambling on disaster. It's like a neighborhood where one family owns a house, but 100 people take out fire insurance on it, and everyone only gets paid if the house burns down. Now imagine how many people quietly start hoping for a fire. That's what the credit derivatives market became: structured incentives for collapse. The virus no one can trace, but the most terrifying aspect of derivatives isn't just leverage, it's interconnection. Every derivative contract has two sides, a buyer and a seller, a winner and a loser. If Bank A loses, Bank B wins, as long as Bank A can pay. But if Bank A collapses, those wins at Bank B turn into phantom profits. They vanish. Now, Bank B can't pay, Bank C can't pay, Bank D. The shock spreads like a financial virus through the balance sheets of institutions around the world. This is called counterparty risk. It's the risk that the person who owes you money in a crisis can pay you because they already dying from the same crisis. Think of the system as an enormous web of promises. Derivatives are strands in that web. When one major node rips, the tear doesn't stay local. The tension redistributes. Other strands snap. And because no regulator sees the full web, no one knows where the next snap will happen. In 2008, that first major tear appeared at a familiar name: Lehman Brothers. On the surface, Lehman looked almost solvent. In the footnotes, it carried over $35 trillion of derivatives. When Lehman went down, those contracts didn't just vanish quietly. They detonated. In the next part, we'll walk through exactly how Lehman and AIG turned a U.S. housing problem into a global near-death event, and why the same wiring is now connected to a system 10 times larger. To understand why the next crash will be worse, we need to revisit the last one, not the headlines, but the mechanics. Because what happened in 2008 wasn't just a housing collapse. It was a derivatives detonation, and the fuse was lit at one bank. Lehman Brothers. The illusion of solvency. On September 2008, Lehman Brothers reported $639 billion in assets, $613 billion in liabilities. On paper, they looked damaged, but not dead. But buried, deep in their disclosures, was the real number: $35 trillion in derivative exposure. These weren't tangible assets. They were bet swaps, credit derivatives, interest rate contracts spread across partners around the world. When housing prices began falling in 2007, these derivatives began losing value fast. Lehman's trading partners demanded more collateral margin calls the bank couldn't meet. By September 2008, Lehman was effectively frozen out. No one would lend to them. No one would trade with them. The world sensed blood. When Lehman finally collapsed, the impact detonated through the global web of derivatives with terrifying speed. The real danger wasn't Lehman dying. It was what Lehman's death meant for everyone else. When Lehman failed, every derivative contract it had ever touched suddenly went into limbo. Not erased, defaulted. Now imagine the shock. A pension fund expecting payments from a Lehman swap suddenly received nothing. A European bank that had bought credit protection from Lehman was now fully exposed. A hedge fund holding interest rate swaps found its hedges worthless. In minutes, institutions around the world were staring at losses they hadn't modeled, didn't understand, and couldn't absorb. This is the hidden horror of derivatives. One failure doesn't stay isolated. It ricochets. The collapse of one institution becomes the collapse risk of all institutions. The web doesn't dampen failures, it accelerates them. Then came AIG the moment the system nearly died. AIG once, the largest insurance company on earth, was sitting on nearly $1 trillion in assets. It was seen as safe, conservative, stable, but deep inside its London financial products division, AIG had quietly sold $500 billion in credit default swaps. Think about that. They insured $500 billion of risky mortgage-backed securities and set aside almost no capital to pay if those securities failed. Why? Because models said nationwide housing collapse was impossible. Because regulators believed them. Because the system rewarded short-term profit over long-term stability. When mortgages began failing, AIG owed billions, it didn't have its credit rating collapsed. That triggered clauses requiring even more collateral, which triggered more downgrades, which triggered more collateral calls. This is the death spiral of derivatives. Within days, AIG was insolvent with unpaid obligations that would have destroyed every major bank. So the US government stepped in. Rescue package, no. 1. $85 billion, when that didn't work. Rescue package, no. 2. $38 billion, then another $40 billion, then another $30 billion. Then a facility allowing $60 billion more. Total bailout, $180 billion, the largest corporate rescue in human history. But here's the sinister truth. The bailout wasn't to save AIG, it was to save AIG's counterparties, the banks that would have collapsed if AIG didn't pay them. That included Goldman Sachs, $12.9 billion, Merrill Lynch, $6.8 billion, Bank of America, billions, Deutsche Bank, billions, Société Générale Barclays, UBS, billions more. Taxpayers didn't just bail out AIG, they unknowingly paid off the winning side of derivative bets made by Wall Street. AIG was simply the pipe the money flowed through, $29 trillion. To stop one explosion, when the dust settled, the total global bailout loans guarantees. Liquidity injections reached $29 trillion. That's twice the size of the US economy at the time. And remember, that was with a derivatives market of $60 trillion. Today, that market is $600 trillion. The lesson the world should have learned, but didn't. After 2008, the world had a chance to dismantle the bomb, regulate it, shrink it, limit the leverage, ban the most dangerous products, make the financial system boring again. Instead, banks kept creating more complex derivatives, hedge funds, supercharged leverage. Regulators allowed banks to hide exposures. Off-balance sheet clearing rules were watered down by lobbying. Politicians forgot what happened or pretended to, and by 2015, the market was bigger than ever. Today, in 2025, it is 10 times the size it was in 2008. And stitched into the core of that system are 4 American banks with exposure so large that if even one miscalculates, the entire global financial system could collapse within days. In the next part, we'll identify those 4 banks, their real derivative exposure, and why the system is now mathematically too big to fail, and too big to save. If the first half of this story was about how derivatives destroyed the world once, this part is about who could destroy it next. Because the danger today isn't scattered across thousands of institutions. It's concentrated, terrifyingly concentrated inside just for banks. For institutions carry 90% of all US derivative exposure. They are bigger, more leveraged, and more interconnected than Lehman ever was. And if even one of them slips, the entire global financial architecture would collapse within days. Let me name them. JP Morgan Chase, Citibank, Bank of America, Goldman Sachs. These aren't banks anymore. They are derivative reactors, glowing hot with risk the world pretends isn't there. JP Morgan, the largest derivatives holder in human history. JP Morgan holds approximately $54 trillion in notional derivative exposure. Their total assets, about $3.7 trillion. Their capital, around $300 billion. That means JP Morgan's derivative book is 180 times larger than its capital base, 180 to 1. For comparison, Lehman Brothers was 35 to 1 when it collapsed. Long-term capital management was 125 to 1 when it imploded. JP Morgan is operating on leverage levels never seen before in a stable economy. The bank insists the true risk is small because hedges offset exposures. Lehman said the same thing. AIG said the same thing. Bear Stearns said the same thing. Hedges work beautifully, right up until the moment the counterparty doesn't pay. Citibank, the ghost of 2008, returns. Citibank holds roughly $48 trillion in derivatives, $2.4 trillion in assets, $200 billion in capital. Citi is the same bank that nearly died in 2008 and required the most aggressive bailout in U.S. history. 15 years later, it's bigger, riskier, and even more entangled in the global swap network. If JP Morgan is the heart of the system, Citibank is the exposed nerve. Any shock, interest rate volatility, a sovereign default, a currency crisis hits Citi first and hardest. Bank of America, silently carrying a $37 trillion bomb. Bank of America holds $37 trillion in derivatives, $3.1 trillion in assets, $280 billion in capital. Bank of America is especially vulnerable because a large share of its derivatives relate to long-term mortgage exposure, commercial real estate interest rate swaps from the 2010 to 2020 low-rate era. If commercial real estate implodes, if interest rates spike again, or if mortgage defaults rise, Bank of America becomes the first domino, and not a small one. Goldman Sachs, the most complex book on earth. Goldman Sachs, though smaller in total size, has $47 trillion in derivatives, $1.6 trillion in assets, $120 billion in capital. The problem isn't the size alone, it's the complexity. Goldman creates the most exotic derivative structures in the world. Options on swaps, swaps on swap indices, multi-layered structured notes, synthetic credit baskets. These are not instruments any regulator truly understands. Goldman has effectively built a derivative Jenga tower, where removing the wrong block collapses the entire structure. 4 banks, $186 trillion in derivatives. All interconnected, all dependent on each other's survival. Asterisk, asterisk, JP Morgan hedges with Citi. Citi hedges with Bank of America. Bank of America hedges with Goldman. Goldman hedges with JP Morgan. A perfect circle of risk. It looks diversified, it feels diversified. But structurally, it's a snake eating its own tail. If any one of these banks fails, the others cannot collect on their hedges, their derivative exposures become real losses, their capital evaporates, they fail to this time. The cascade wouldn't take months, it wouldn't take weeks, it would spread across continents within hours. Why regulators claim this is safe, and why that claim is false after 2008. Regulators introduced central clearinghouses for some derivatives. Supposedly, these clearinghouses act like a firewall. If one bank fails, the clearinghouse steps in. But there are 2 fatal flaws. Flaw number 1, only standardized derivatives are cleared. Over 80% of the $600 trillion market is over the counter, meaning no clearing, no backstop, no transparency. These contracts are still private deals between banks, just like 2008. Flaw number 2, clearinghouses don't have enough capital. A typical clearinghouse holds around $10 to $30 billion in reserves. JP Morgan alone holds $54 trillion in derivative exposure. If clearinghouses were firefighters, they would be trying to stop a volcanic eruption with a garden hose. Too big to fail has become too big to save. In 2008, governments could still bail out failed institutions. But in 2025, governments are drowning in debt. Central banks can't print trillions without triggering runaway inflation. Political support for bailouts is gone. Bond markets are too fragile for another rescue. The system has grown to a size that is mathematically unbailable. In the next part, we explore the triggers already forming, the sparks that will ignite the $600 trillion powder keg. Interest rate volatility, commercial real estate collapse, Japanese and Chinese debt crises, European banking fragility, currency shifts threatening the dollar, and the silent buildup of counterparty risk. No model can measure one of these triggers will hit, and when it does, the meltdown will be faster, deeper, and more destructive than 2008. A $600 trillion market doesn't explode on its own. It needs a spark. In 2008, that spark was subprime housing. Today, the fuse is longer, thicker, and wrapped around multiple global pressure points. And here's the part that should keep you awake at night. Several of the triggers are already active, not hypothetical, not theoretical, visible, right now. Each one alone could destabilize world markets. Together, they form the perfect storm. Let's break down the triggers, the ones most likely to ignite the next financial detonation. Trigger number 1, interest rate volatility. The $500 trillion guillotine. Over $500 trillion of derivatives are tied to interest rates. For 13 years, rates sat near zero. Banks built a global casino on the assumption that low, stable rates would last forever. Then, in 2022 to 2023, the Federal Reserve executed the fastest rate hike in 40 years. 0% gives 5% plus in 18 months. This wasn't a speed bump. It was a seismic earthquake beneath the largest derivatives market on Earth. Every rate hike created winners on one side, catastrophic losers on the other. Margin calls, collateral shortfalls, liquidity stress. Regional bank failures in 2023, Silicon Valley Bank, Signature, First Republic were the visible casualties. The invisible casualties, the derivative positions that banks still refuse to mark to market. If the Fed hikes again to fight inflation, or cuts sharply due to recession, or flip-flops because of political pressure, volatility alone could trigger cascading derivative losses. Banks can hedge risk, they cannot hedge chaos. Trigger number 2, commercial real estate. The slow-motion collapse. Over $2 trillion in commercial mortgages must be refinanced by 2027. The problem: many buildings are now worth 40 to 60% less than before the pandemic. Remote work gutted office demand. Malls are dying. Urban retail is collapsing. When refinancing hits, interest rates will be triple the old loans. Cash flow won't cover debt. Buildings will default. Banks will eat losses. Credit default swaps will trigger. This isn't a warning. It has already begun. Brookfield defaulted on $784 million of office properties. Columbia Property Trust defaulted on $1.7 billion. Major cities like San Francisco and Chicago are seeing ghost towers. Each default is a small tear. Enough tears create a rip in the derivative fabric. Trigger number 3. Europe's banking system is cracking. The collapse of Credit Suisse in 2023 wasn't an isolated event. It was a preview. Credit Suisse carried trillions in derivatives. When it imploded, UBS was forced to take it over in a government-orchestrated emergency rescue. Regulators celebrated, but behind closed doors, they knew the European banking system is fragile. Deutsche Bank still carries over 40 trillion in derivatives. French banks are drowning in commercial real estate losses. Italian banks hold mountains of risky sovereign debt. A single major European bank failure would send derivative shockwaves straight into JP Morgan, Goldman, Citibank, Bank of America, because they are all counterparties. One collapse in Frankfurt becomes a collapse risk in New York within hours. Trigger number 4. Japan, the most dangerous debt bubble on earth. Japan's government debt is 260% of GDP, the highest of any major economy in history. For decades, Japan kept interest rates near zero, allowing the system to survive. But inflation has returned. Japan is being forced to tighten. If Japanese bonds fall, if the yen collapses, if foreign investors flee, the derivative exposure tied to Japanese rates and currency will detonate globally. Japan doesn't need a crisis. It needs a tiny wobble. Even a small shift can trigger billion-dollar derivative losses in the US and Europe. Trigger number 5. China, the quiet financial implosion China is facing. Collapsing real estate giants, Evergrande Country Garden, $13 trillion in hidden local government debt, shrinking population, slowing economy, capital flight declining, exports. China's real estate sector alone was 30% of GDP. Now it is in freefall. Derivative exposure to Chinese debt is deep, hidden, and unregulated. If China's financial system cracks, Asian markets collapse, European banks with exposure fail. US banks face derivative losses from Chinese swaps. We've never had China, Japan, Europe, and US fragility happening simultaneously. Until now. Trigger number 6. The dollar's erosion. Currency derivatives at risk. Currency derivatives total about $100 trillion. For 80 years, the dollar has been the world anchor. Banks assumed dollar stability. But in the last 5 years, BRICS accelerated de-dollarization. Saudi Arabia broke the pet. China and Russia trade in yuan. India buys oil outside the dollar. Dozens of nations are stockpiling gold. If the dollar weakens sharply, trillions in currency, derivatives become mispriced. Margin calls rip through markets. Banks face losses they didn't anticipate. Currency crises are violent, fast, and unforgiving. Why this time can't be saved in 2008. Governments spent $29 trillion to prevent collapse. Today, the US is $36 trillion in debt. Europe is drowning in debt. Japan is beyond rescue. China is hiding defaults. Inflation limits money printing. Politics blocks bailouts. Central banks' credibility is gone. The system is so large it cannot be stabilized. Too big to fail has become too big to save. What happens when the collapse begins? Once a major counterparty fails. Derivatives default, hedges fail, clearinghouses run out of capital, banks freeze withdrawals, credit markets halt, global trade stops, pension funds implode. ATMs go down, unemployment spikes, currencies panic, governments impose capital controls. This won't take months, it will unfold in days. Because derivatives move at digital speed. The $600 trillion time bomb is ticking. This is not doom fantasy. This is mathematical inevitability. A system that needed $29 trillion to stabilize at $60 trillion cannot survive a failure at $600 trillion. The only uncertainty is which trigger blows first. Interest rates, real estate, Japan, China, Europe, the dollar. We don't know the spark, but we know the outcome. History repeats. 2008 was the warning shot. 2025 to 2027 is the main event. And when the derivatives bomb detonates, the world will enter a financial era unlike anything seen since the Great Depression. This is the part of the story most people will only understand after it happens. But you see it coming.